All right, I'm Michael Hartzman. Today is Tuesday, June 3rd, 2025, and I'm on as always with my partner, Dominic Tavella. How are you, Dom?
Doing well, Mike. No complaints. How about yourself?
Good. It's been a couple of weeks since we've done a podcast. Seems like a minute, but lots been going on the last 3 weeks. And believe it or not, Dom, I know you believe it because you live it. The S&P 500 entered positive territory at the close last Friday. Who would have thunk it?
Uh, Mike, I was watching one of the financial companies, service company channels, and one of the analysts said it best. If you took a nap on January 1st and woke up today, you would have fit nothing happened. You literally would have said, it's been kind of quiet all
Yeah,
year.
sleepy
And
market.
nothing but, right, Mike? Nothing but.
But Dom, we've seen the movie before, and volatility. I just think now is a way of life in these markets. The last time it took a really long time for a market to kind of recover was 2008, 2009, right? And it was years before it got back to where it was before the financial crisis. Now, between the pandemic and just sell-offs in general, you know, these market crashes just don't last as long as they used to. I don't know what's changed about them, but they just seem to be a way more elastic than they used to be, these markets.
Yeah, I mean, Mike, I think literally there have been textbooks written on the subject. You used to have those mega type corrections in the market. I think they were economic driven. There'd be some kind of effect that would affect not only U.S. economic growth, but maybe global economic growth. And you're looking at economies today, and maybe because we're more of a service-oriented economy, maybe because really the economic picture that we're in right now. But you are correct. These things seem to be triggered by some kind of a headline, as this last one was, multiple headlines. And then once you realize, hey, maybe the news is not quite as bad and or there's at least a path to fixing it, then markets recover and recover pretty quickly. So it's another one of those where if you had blinked, you might have missed it, or if you reacted emotionally, you would have missed the recovery.
And that does make me a little nervous for the investing public because it also creates an environment, Dominic, where investors could get complacent, where they don't think they have to asset allocate and make sure that their risk tolerance is appropriate. If they're like, oh, there's nothing to see here, I'll come back in a month and see where we are. Yes, it's good to be patient. And yes, it's good, not to overreact. But at the same token, you also want to be mindful of your risk tolerance to make sure you're not, taking risks because you think you can never lose money if you just stick around for, an extra week or two.
Look, I have two quick thoughts. The first is, I think as an industry, we've done a good job of telling people, hey, think long term. Don't try to react to the day-to-day headline, and especially if you're looking at something like a retirement account or a custodial account or a 529 for your children, grandchildren. Hey, these accounts are going to be around for decades, so don't be so quick to overreact to an event, right? An event that eventually this too shall pass. The flip side of that, Mike, is that, and I know it happened to me, where clients thought they understood what their risk level was. We are really, really, as a firm, as both of us, disciplined about trying to assess what the client's risk profile looks like and making sure their account is coded that way. But living the ups and downs, you realize, oh my God, I didn't realize that was the kind of volatility I might experience. And so when the markets do recover, that's when you need to kind of reassess and look at that risk profile and go, hey, was that okay? I could live with that. Or maybe it's a good time now that the markets have recovered. Maybe I should re-examine that risk profile and do something about it.
I mean, what was the S&P down, on April 8th after it freaked out about these tariffs that the administration put in? Was it down like 17%?
Yeah, if I remember correctly, the Nasdaq was slightly over 20, and the S&P probably in that close to 18% range. I
Yeah.
think you're right, Mike.
Yeah.
Okay, so I want to say plus or minus 20% for the major indices, but and then again, within a month and a half, basically, maybe two, to have it all back.
It's a hell of a trip.
Hell of a roller coaster ride.
And the crazy part is, Dominic, other than the president, you know, making these proclamations, backing off, making them backing off, nothing's really changed.
Well, so Mike, a loaded question back to you. Is that the good news or is that the bad news? Um,
I just think it's the news, right? I think it's both, right?
part of my worry is that clearly, obviously, the markets reacted very violently down based on the tariff news and the announcements from the Trump administration, and then we've seen an equally active, violent reaction back up because it seems that he's softened his stance on tariffs. But the reality is nothing has changed, Mike. You hit the nail on the head with that comment. Nothing has changed. We still don't know what the tariffs are going to look like. We don't know the timeline for that. We don't know which country, and I go on and on and on. Well, we have limited hours here to talk about it, but we still don't know. Nothing has changed.
And here's the other part that's a little befuddling to me. And you and I, we talk about it. We do not rehearse this show. I haven't talked to you all day, right? So we just hop on, we start talking. So explain to me if you can. I know I'm putting you on the spot a little bit. How is the EFA, right, which is European markets, how is the EFA up 17% year to date if these tariffs, if and when they go into effect, they're part of the direct victims of that? So, yeah, I could understand our round turn. I get it. But how do you explain the European markets being up over 17%?
So I hate the word explain, Mike, because that actually implies that I know what I'm talking about, and clearly I don't. But the explanation we've been given is multi-layered here, starting with these stocks in general had underperformed for a very, very, very long time, and I
10
mean a
years?
decade.
Yeah, 10 years. 10
A
years. Yes.
decade.
Yes.
So from a valuation perspective, what the companies were worth on paper, they were far, far, far behind their counterparts here in the United States and maybe their counterparts somewhere other parts of the world. So from a valuation perspective, they were cheap. Europe started cutting interest rates and is cutting interest rates more aggressively than we are, and that's stimulative to the economy. The local governments, think of the UK, think of Germany, think of France, Italy, they've been very aggressive in stimulating their own economies, putting money into to get their economies going. And then probably I'll say the most important one, but the one that really is glaring is due to the Russia-Ukraine war. These countries have decided, and finally maybe really decided, Mike, that they need to really, really increase their military spending, obviously into their own military industries. And again, that is incredibly stimulative. It creates jobs, it creates revenue. So they've have a lot of things going in their way. But even today, the value of these companies is substantially below the U.S. counterparts. They have a long way to go.
Yeah, no, it kind of was a little bit of a loaded question because I do know for a long time that Europe took way longer to recover from the COVID pandemic, which is 5 years old already. So, yeah, I mean, they're just due, right? But I just think It's not so much that they're up, it's just they're up so much more significantly than our markets.
And again,
Um,
with the caveat, Mike, that and you brought it up already, for a decade, basically, they lagged way behind U.S. markets. Um, and we can throw emerging markets into that conversation as well, Mike.
yeah.
But coming back to a point that you made, Mike, talk to us all a little bit about what happens if these tariffs go through, particularly Europe, that it is very, very dependent on trade with the U.S.
No, absolutely. And look, I think what's happening now with the goalposts continuing to be moved will continue to be moved, right? Trump may send out an angry tweet, a mean tweet at 2 a.m., but when markets reopen and things have to stabilize, he typically backs off, which is what earned him the nickname, which he's not a big fan of, right? Taco Trump. And it wasn't from the Democrats, it wasn't from the haters, it was from the the Financial Times gave him that nickname, which is crazy to me. But but it's kind of true, right? I mean, he calls it negotiating. Financial markets call it chickening out. I think that's a little harsh, but it's all part of the ride.
Yeah, I expected just in general, a much more dramatic reaction by this president. We all know his ego kind of drives the bus a little bit, being polite. Um, but we've talked about this one a long time, Mike, on this show and other formats. It is this guy's style, right? He literally, from people that know him back to when he was a developer here in New York, he asks for the moon and the stars. In negotiations with these casinos in Jersey, he asks for the moon and the stars and demands it even. And then he'll back off and settle for something that is more reasonable. So I don't know that he's necessarily backing off his stance as much as, hey, he pushes it to the limit, looks at where markets react, particularly the bond market, Mike, and we may spend a little time talking about that as well tonight. And then, hey, all right, I pushed it to the limit. Maybe I need to back it off a bit
Yeah.
because breaking everything in the China closet is not a good strategy.
Pun intended, it's a China closet.
He was not intentional, Mike, but I'll take it.
There you
So,
go. And look, I think exaggerated a little bit when I said nothing basically has happened. There's obviously been headlines. I think the market is a little bit suffering from tariff fatigue, but the market, has been really shrugging off headlines that haven't been great lately. And the one, Dom, to me that sticks out like a sore thumb is on May 16th, Moody's, one of the three major rating agencies, downgraded the US's credit rating. Um, and now, for the first time ever, all three of the major credit ratings agencies have downgraded US paper from the best rating of all, which is AAA, to now AA1, and basically means it went down one notch. But normally that's a big deal. That's a headline. That sends tremors down the market, spine normally. So the next loaded question is on May 16th. Do you think the market closed up or down that day?
well, yeah, and I'm going off the top of my head, Mike. I think the first part of the day, it looked like the market was gonna get slammed. And then I think it reacted and turned around and ended the day positive. So
Yep.
I'll let you correct me if that was
Nope.
wrong,
Slightly
Mike.
positive. And the next day it was positive as well, slightly.
But I think you're making an extremely valid point here, Mike. Both you and I remember when the first credit agency lowered the U.S. Remember AAA, right? As you
Hmm.
as you pointed out. I think that week the market had maybe one of the worst weeks in its history.
Yeah.
Now, of course, we've never defaulted. We've always made our payments, interest payments, and principal payments when the bonds matured. But the idea that the U.S., the gold standard for the entire world, would get downgraded was almost catastrophic. And today, maybe because it was the third agency to do it finally, what took them so long, maybe because as long as we keep making our interest payments, it doesn't matter. But it was actually a little startling how little the market reacted to that.
And the headline was that they lowered Moody's excuse for lowering it, or justification, I should say, was, the deficit, which really has not been paid much attention to. The debt is just going to continue to grow and grow. And this new tax bill, according to them, will add 4 trillion in debt over the next decade. And then you get the Republicans on TV and they always just attribute it to funky accounting. But, Moody's downgraded the government only because this mountain of debt is growing and neither party seems to have the political will to do anything about it.
Yeah, a recent interview that Treasury Secretary Bassett
Bassett, Bassett.
um, he mentioned, yes, it potentially could be 4 trillion over the next decade, but what the budget does not account for is the increased revenue from tariffs, which they estimate could be as much as $1 billion, $1 trillion, excuse me, over the next 10 years. Another trillion coming in from Doge and cost cutting, cost savings. Another trillion coming from savings from Medicare, Medicaid, prescription pricing. And I think that final trillion, I think, was just economic growth. So the Republicans do think that over the next decade, that'll flatten out. And we won't see this 4 trillion. But clearly they have, for all the talk they've had and done, Mike, they have not aggressively looked to cut the deficit.
No.
Be
And look,
honest.
and I
Let's be
give
honest
the
about it.
administration credit for trying to get rid of waste and abuse, but I think cutting 1 trillion from Doge is optimistic. I hope you're right, but I don't think they're getting to $1 trillion because there's too many things that are just baked in the cake, like U.S. Treasury payments, like Medicaid payments, and like defense. It'll be very difficult for them to find $1 trillion.
And look, Mike, I mean, we all read the papers and look at the headlines, and supposedly they have found some pretty dramatic places where money was being frivolously spent or embezzled or whatever. Yet, I don't know if anything is actually done yet about
Yeah.
it. So think about that, Mike. Okay, let's, for argument's sake, you found these expenditures that weren't appropriate, and you can figure out how to save some money for the taxpayer. Well, why haven't you done anything about it?
Yeah.
And
And
it's
look,
nobody wants any cuts in their district.
correct. Correct. So let's just put a bow on this part of it. We talk about headline risk and the market and what's going on. So let's talk about the VIX, the volatility index, which basically, I think, measures sentiment, right, among investors and how panicky they are or how complacent they are. And on April 8th, when it was the day after, I think, that the Trump administration announced all these tariffs, the VIX hit, I think, 48, which was a recent high. And I'm going to check my notes right now. And right now the VIX is about 28. So the VIX, Dominic, what that means basically, to our point that things have really calmed down, is that the market basically had a short-term anxiety attack on April 8th where it got to um what
Almost 50.
yeah, it was almost 50. I'm right, right?
Yeah.
And now it's down to 18, 17.69. So again, I think that's another indication, Dom, that people, investors overall, either have fatigue from all these tariffs. Um, they think Trump is the boy who cried wolf, or or they think the economy can handle it. And I think for me, the answer may be all three, but I don't think we're out of the woods yet because there was real damage that's been done to the economy because of these tariffs. And we really won't know what they are until July.
If we're fortunate, Mike. So back to earlier comment you made about complacency. So, just in the last week, the Trump administration announced and they confirmed them today, by the way, another 25% tariff. So it's 50% tariff on steel that's being imported into this country. And over the weekend, there was some pretty harsh commentary going back and forth with the Chinese government. Well, you violated our agreement. No, you guys violated the agreement, and so the ping pong ball is going back and forth. And yet, last week the markets ended the week higher.
Yeah.
And at least okay, this is Tuesday, but so far this week they are higher. And you're like, well, wait a minute. We know back in April those kind of headlines would have literally wrecked the markets. We saw 5% moves in the market in a day, 5% down, and then there would be some kind of press release from the White House, and 5% back up, and then 5% down, and it's 5% a day moves. And that ties into your VIX commentary. That really measures the volatility that and the risk that the markets perceive. And we are sitting with some pretty significant announcements, and yet markets just shrugging it off, Mike.
Yep.
So I think all three of your points are spot on.
Thank you.
We have a lot of complacency right now, whether it's we're just tired, exhausted, don't think it's going to come to fruition, but I think personally, maybe a little bit too much complacency.
Absolutely. And any of our listeners and clients who want to follow this benchmark, the symbol is VIX, Viking Indian X-ray. It trades like any other stock. You can actually buy it. I don't recommend you do, but it does trade. Um, Actually, I'm sorry, it does not trade. I don't know why I said that. It's a measurement, but I'm looking at it now, and you cannot actually buy it. There's no volume on it, I don't believe. But nonetheless, it is a good index to keep an eye on how people are feeling about the market.
Um, so let's pick up a comment you made, Mike. We both agree we're not done with this one yet. So what do you see? What do you think this picture looks like over the next 30, 60, 90 days?
I think I think typically when investors get a little bit too complacent, the headlines will step in, and I think we're very very early into June. I think in a month, when this month is over, and the data starts to come in, whether it's consumer confidence or gross domestic product or any other benchmarks that are used, the JOLTS report for jobs, and we really see what damage was done to the economy, I think that'll be a better precursor of what the second half of the year might look like. What do
Yeah,
you
we
think?
we we have a jobs number this Friday, and again, the process literally never ends. Every week we get another piece of data. So does the Federal Reserve, probably more in tune than we are. But it's kind of this mixed story, right, Mike? Where we get one piece of data and like, oh well, the economy is not really doing all that bad, and that would be in the jobs numbers we've been seeing, the unemployment numbers we've been seeing. Even corporate profits have been relatively good. Not great, not spectacular, but relatively good. But the GDP number, economic growth number, first look at it was negative, right, Mike? So I don't know if it'll stay that way, but that's not a good sign. And we know the consumer's under duress. Credit card delinquencies are up, car loan delinquencies are up. And we certainly know the lower half of the consumers are struggling with the amount of credit card debt they're carrying. So, we're going to continue to get this data, but it's not quite black and white, Mike. So back to, I don't know that we're done with this volatility.
The other thing is, Dom, we got an inflation number that actually went down a little bit the last report. But then I personally see these tariffs really hitting home. I mean, things are just they're more expensive now, right? I mean, they just are. So I think that also will start to filter into the economy as well.
And again, a subject that we've covered quite a bit. We don't know what the tariffs are going to be at the end of the day. Once they are assessed, does the manufacturer in China or Europe pay all of it or some of it? Does the importer that brings it into this country pay some of it or all of it? Does the consumer pay some of it or all of it? So you have to believe some of the cost is going to end up getting passed on to the consumer. And then how resilient, how committed is the consumer to actually buying these products that are going to be more expensive? Who knows, right,
Yeah.
Mike? But we do have, on a positive side, we've had pretty significantly lower energy prices.
Hmm.
And when you think about a Walmart, right, or a FedEx, the cost of transporting their goods from point A to point B, the cost of operating these large facilities and warehouses, flying planes. If you can bring your energy costs down 10, 20, 30%, and we are talking about those kind of numbers, Mike, that
Hmm.
literally could offset the 10, 20, 30% tariff on the other side. So we don't know the outcome yet, but I do agree with you. There has to be some inflationary
Yeah.
pressure coming
You know,
through.
I was talking to a client this morning who he owns with his brother. It's a second generation plumbing, heating and plumbing supply company, and he was telling me that always in the summertime, these distributors run these deals to get a company like his to buy a lot of product and have it in a warehouse, and you kind of have it through the fall and the winter season. And he said to me, he goes, I don't know what it's going to cost, so I'm cutting my order by two-thirds. Because why would I lay out an extra 30 or $40,000 if it's going to be that much cheaper in September? And if it's the same or more, then I'll just buy it now. And again, it's very anecdotal, Dom, but there's got to be a million stories like that throughout the entire economy.
Yeah, Mike, it's more than anecdotal because we saw the import numbers through the first quarter go up by 40%. Companies were pre-ordering and getting product into this country in anticipation of what the Trump administration might do. Now that we've had a pause, we've watched orders pick up again because there was a pause. We don't know yet. So the bottom line is that some of this economic data that we're getting is this sort of schizophrenic reality of will we, won't we, what is it going to be, what's it going to cost me, and should I or shouldn't I order product? Just exactly what you described, Mike.
Yeah. Well, look, let's take a break here, catch our breath, get your crystal ball out, rub it down, because we're going to talk about interest rates and a little bit more on inflation when we come back after this break. All right, I'm Michael Hartzman, back with my partner Dominic Tavella. You and I just discussing the markets tonight, Dom. No guest. Time always flies when I have your undivided attention. So let's talk about interest rates. I think we mentioned it a few weeks ago. One market watcher we watch very closely, Dr. Jeremy Siegel, thinks that Trump is right in pounding the table, and that Powell should lower interest rates immediately. Another one of our uh, fanboys is Rick Reeder, head of fixed income at BlackRock. We love listening to him. He said that the Feds were right; they should not lower interest rates anytime soon. Jerome Powell made a comment last week. I'm sure you saw the headline. The decision will be data dependent and not political. So, what do you make of all of that?
Didn't he actually go to the White House, Mike, and hold hands and sing Kumbaya with President Trump after their verbal feud? Interest rates. Well, look, we know, especially this Fed is data dependent. They say it, they mean it, they've acted accordingly, whether their actions have been correct or not. In hindsight, we could sit here and judge all day long, but they literally are following the data. And the data that they're focusing on is, where is inflation? Is it coming back down to their target 2% rate? And of course, the other data point they're looking at very carefully are the unemployment numbers. And so their dual mandate is to have unemployment as low as possible and inflation within that 2% target that they're looking to hit. So first half of the story, inflation's been coming down, Mike. We mentioned already energy prices. We've watched real estate prices, housing prices, which are a big component of the inflation data, how they come up with that final number. But real estate prices have been coming down, cost of materials been coming down, cost of labor has been coming down. Remember, we kind of had a little bit of a squeeze on labor a couple of years ago, and labor costs were going higher. That's been flattening out. So the good news is that the inflation data is coming down. The bad news is still not quite where the Fed wants it, but we're within range. We're within striking range of that. And as you mentioned, Mike, we're going to get clearer picture over these next couple of weeks. And the employment numbers have stayed relatively healthy. We've watched them tick up slightly, but job creation and unemployment, the numbers have been, relatively speaking, pretty good. So should they cut immediately? I don't think they feel they have to, Mike.
I mean that's the point, right? Whether they should or shouldn't, they feel they don't have to, and the data, you know, I think at the moment kind of proves that out. And clearly, lower interest rates would make these tariffs a little easier to swallow. So of course the administration wants lower interest rates. And I think other than the end of 2021 and beginning of 2022, when Powell called inflation transitory at that time, which was a misstep. I think for the most part, under his leadership, which was through the pandemic and before that, he's done a pretty good job of guiding this economy and avoiding a full-blown recession.
Well, I'll apologize ahead of time, Mike, if you'll allow me to state the obvious. The idea that you're data dependent, your data is backwards looking, right? You're looking, what was the unemployment number last week, last month, last quarter? What was the inflation numbers last week, last month, last quarter? What was GDP growth? So you're looking backwards to determine what you think the future might look like down the road. So yeah, they're going to be reactionary to the data, and they're going to be a little bit behind the curve. But I do agree with you, Mike. I think overall they've done a pretty decent job. They had a few miscues with that whole letting inflation get a little bit ahead of itself. And then, of course, the Biden administration did nothing to help the inflation numbers and or the Fed in doing their job. So I think overall most people would agree we're in a better place now, and certainly with regard to inflation and heading in the right direction.
So let's switch gears again and let's talk a little bit about the bond market. I know you love talking about the bond market, and frequently it's the bond market that can, be the precursor to what the stock market's going to do. And again, we talked about this as well, whether it was manipulated or not. The bond market took quite the tantrum as well, right around the time those tariffs were announced. Really got the Treasury Secretary's attention. He made sure he got Trump's attention. The 10-year was trading below 4 at one point, 4%. So, it's rebounded. It's kind of looking a little bit more normal now. But what do you think of the Treasury market and the 10-year in particular, which seems to be a really important benchmark?
Well, maybe this is where you're going, Mike. We had Jamie Dimon from JP Morgan Chase this past weekend talk about there's some significant cracks in the bond market, and he made some rather headline statements about that those cracks could be pretty substantial and perhaps create a crisis in the bond market. We don't see that at this point. Again, not that it can't happen, but we really don't see that. We look at credit quality, we look at what we call spreads, the difference between a higher quality bond, the interest rate, and a lower quality bond, and everything's telling us these days that there is pressure on the bond market, but nothing that would create a crisis at this point. But it still comes down to, Mike, people's willingness to buy these bonds, i.e., to collect the interest, right? So if they deem that inflation is going to be very high going forward, they're going to demand a higher interest rate. If they deem that there's risk in owning these bonds, and we talked about the credit rating being lowered. So theoretically, if the risk is higher, you're going to want to get paid more interest on these bonds. So we have seen the longer maturity bonds. You mentioned the 10-year interest rates higher today. Um, Clearly the bond market is, I don't want to say sounding the alarm bells, Mike, but yeah, maybe a little flashing yellow going, hey guys, be careful how much your budget deficits are going to be. Be careful how much the total outstanding debt America has. But I think it's a yellow warning light, Mike. I don't think it's red.
And to your point though, right? We have this really people are actually calling this big beautiful bill. Um it's good, look, the headline, Dominic, is going to be tax rates are going to be lower or the same, which is going to be positive. It's not going to be the focus is not going to be the deficit or what they're adding to the deficit or not. So at the end of the day, I mean, I obviously I agree with you. You know, people want to have a stable government and a government that can pay their bills. They also want lower taxes. And I would argue that it's other nations, other gigantic companies, endowments, universities that are buying the 10-year treasury. I think the consumer and, the working man and woman, they just want lower taxes down.
Yeah, and again, we're still trying to figure out what this new big beautiful bill is going to look like, but it is all about maintaining the existing
Hmm.
tax structure. So I think on the margins that you might see some credits to parents, you might see some benefits. I still talking about no taxes on tips or such. When we really look at it, it really comes down to, hey, these were tax cuts that were passed during the prior Trump administration, and they just want to leave them in place because they are due to expire by the end of this year. So in and itself, that's probably not going to drive the bus in terms of economic growth. We already have these tax cuts structure in place. We're already living with them. We're not going to get extra money in our pocket, Mike, via a big tax cut. So that in itself is not going to stimulate the economy. It might take some of the stress away, but it won't stimulate the economy. And we talked about the spending side of this bill, even though um, they were supposed to cut spending, Mike, and we're not seeing that, right? Are you seeing something I'm not? Maybe I should have asked you the loaded question. Um, We're not seeing
No,
the big cuts they talked about.
no, we're certainly not. And as I said before, I think, Elon Musk and his crew said they could cut $1 trillion out of waste. It's not going to be $1 trillion. It's just not going to be. And 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 you're right. I'm glad you said it. The media is going to call it a tax cut. It's not. It's just pretty much where we are
Status
right now.
quo. You're leaving the
Yeah.
status quo. And look, it's becoming a little bit more public on a daily basis, but Musk is rather frustrated in that whether it's true or not is a whole nother conversation, but they feel they have discovered some pretty significant places where money is being wasted, money is not being spent wisely, money is being defrauded from the taxpayer, the government, the taxpayers, and they want to be proactive, yet Congress is not helping them do their job. So a lot of this stuff needs congressional approval to get it done. So at the end of the day, these congressmen and senators have to do their job, Mike. And you could argue that maybe, well, at least for now, I don't want to say they're not doing a good job. All I'm saying is, doesn't look like they're doing a lot to cut waste and fraud.
So just getting back to the interest rate conversation and an inflation conversation, I don't. I think it would be miraculous if inflation doesn't tick up in July, right? With the things being more expensive. So if by some miracle inflation stays stable or maybe ticks up a tenth of a point or 2/10 of a point, do you think that gives the Fed the impetus then to begin lowering interest rates?
Um, well, certainly if it picks up, that gives them more impetus not to lower interest rates.
Exactly. No, exactly. So if by some miracle it doesn't tick up, right? It stays relatively stable, does that give them the cover they need or the data they need to say, okay, maybe we've gotten through this part of,
Yeah. So two parts. The first is Mike. This again, you read the same stuff I read. You hear the same experts that I listen to. There's quite a bit of chatter now, unlike the first part of the year, where they're saying no cuts at all this year.
mm,
That would have been sacrilege in January,
hmm
as the markets were expecting at least two, maybe as many as four cuts. And early on, I think the markets were genuinely disappointed in March that the Fed didn't cut rates. So now you're starting to hear this chatter, no cuts at all. And then coming back to a question you asked a few minutes ago, um, we are seeing significantly lower energy prices.
hmm
Something as silly as eggs, but egg prices have dropped pretty dramatically. I don't know that the tariffs kick in by July. You already brought this up, Mike, and I agree with you. I think they just keep getting punted down the road. So I don't know that we'll see real resolution in tariffs by July. So you actually might have a continuation of this de-inflationary environment where that number starts to get even closer to what the Fed is looking to accomplish. And we've seen tons and tons and tons of data, Mike, where the consumer really, really is starting to hold on tight to their money. And the mere fact of them not spending that money lowers costs. And sorry, I'm talking nonstop, but this morning, hotel rooms, airlines, travel significantly down into the summer, significantly down. So that means hotel room prices have to come down, airline tickets have to come down, resort pricing has to come down to attract that consumer to come in, right? So I think we continue to see better inflation numbers over the next couple of months.
You mean stable.
Yeah, I mean, I think the last number we saw was what, about 2.3-ish,
Yep.
Mike?
I think 2.2 or 2.3. Yep.
And again, the target for the Fed is 2%. So could we see 2.2? Could we see 2.1? Could we even see 2? Yeah, I think over the next couple of months, it's possible. if the tariffs don't kick in.
Right. If they do, kind of, again, it's all
Then
bets
there's
are
another
off.
fudge factor in that number.
And then the other part of interest rates, Dom, is the housing market and the real estate market. And it appears to me that the real estate market's rolling over a little bit.
Yeah, we're again looking at data. It seemed one of the biggest issues we were dealing with over the last couple of years, there just wasn't a lot of inventory. Real estate prices were going higher, and people that own these homes, like, why should I just put it on the market and sell it? I'll just wait, and the price of my house will be worth 10% more or 20% more. Well, that's kind of capped out, and where you used to have 50 people lined up to buy a house, Mike, and they would each be overbidding each other to get it. Nowadays, and we saw something this morning, we heard something this morning where you're lucky if you get two, three people to even show up to look at your open house. So, and it's regional, by the way. It's not, it doesn't look that way every state in the country, every city in the country. But it's a clear difference from what it looked like a year or two ago. Again, all of it de-inflationary,
Hmm.
right? So if you're not buying a new house, you're not putting in a new kitchen, you're not buying furniture. It's so intertwined with economic activity. Real estate, by far, is one of the most significant drivers of economic activity.
And to prove your point, right? And we're talking about data dependency. Here's a big shocker. Of the 11 major indices, guess which one is dead last? Consumer discretionary is the worst performing sector year to date, down 6%. Negative still, 6%. Energy is down 3.9. Healthcare is down 3.1. And then on top of the pyramid, utilities are up 9.1, industrials are up 8.8, and consumer staples are up 8.5. Why? Because whether we have inflation or tariffs or whatever the case may be, you still got to buy food, you still got to buy toilet paper, you still have to buy soap.
You're still going
Like,
to turn the electricity on in your house. You're still going to all of what you said, Mike, is basically proof positive of what you and I have been discussing now for the last half hour or so. The discretionary implies that it's discretionary. You can decide not to buy the luxury item or maybe to go out to dinner or order the product on the internet to be shipped to your house, right? But you got to put food on the table and you got to turn on the water and you got to electricity and healthcare is down for other reasons, but normally healthcare is one of the safe harbor places to go and put your money in this kind of environment. Because hey, if you need Lipitor, you're gonna go. Doctor says take it. You're gonna go take it, right? If you need a knee replacement, you're gonna go get it done. But we have an administration again that is really, really going after the healthcare industry, prescription drugs, based on what the costs to Medicare and Medicaid are. And so those stocks, those companies, that sector has been punished for that.
and I think that's a good thing, by the way.
Yeah, Mike, and we could probably do an entire show just on this subject, but the balance between, hey, we need the extra money so that we can do research and come up with the next cancer drug or the next antibiotic, whatever, and vaccine. On the other hand, you're selling the exact same medication in Europe or Canada or Mexico for 10% of what you would charge here in the United States. That's stark, right, Mike? I mean, literally, you could afford to fly to Europe, get your medication, and fly back, and actually save money in the deal. So, Lord knows we have friends and clients that order their prescription drugs from Canada. In a country like ours, that shouldn't be the case.
You're right. I mean, obviously, I could not agree with you more. And the flip side of that, again, we're not a political show, but a lot of also that research and development is done at universities, right? So it's also a fine line. If you pinch everything off, who is going to do that research, right? Who's going to invent that next miracle drug?
Yeah, so the healthcare sector in general, again, we've talked about it. The drug companies, all of them have gotten beat up pretty good. But I remember the Obamacare days, Mike, where similar, based on Obamacare, it was deemed that drug companies and pharmaceuticals and healthcare companies weren't going to do well at all. And in fact, they did just fine, Mike, and the stocks recovered, and people made a lot of money in that sector. So, all I'm saying is we don't know if that same thing is going to happen this time, but maybe like the budget fight we're going through right now, the bark is way, way worse than the bite. At least with regards to how they go after these companies, and how much profits they'll ultimately be allowed to make.
Yeah, look, and ultimately, I think the healthcare industry will be fine, right? I mean, we're all living longer, but that doesn't make us necessarily healthier because we're still a pretty fat country. No, no, no offense.
You weren't looking at me when you
No,
said
well, yeah, no, I was not. I was not. All right, we just got our signal. We got 4 minutes to go. Um, any pearls of wisdom in 4 minutes? Put a bow on this?
we've spent quite a bit of time on this one, Mike, but you can't believe you. I don't mean literally you. I'm the general public. You cannot believe that we are through this. That the volatility is over. You can't. Yet the markets are behaving like it, Mike. So, look, I think it's prudent to things like re-examine your risk profile, right? Hey, we just went through a pretty nasty roller coaster. Was I okay with it? Can I live with it? Re-examine your expectations for what a reasonable rate of return is, and understand that next tweet might create another volatile reaction by the markets, but that too shall pass. But it's not over, Mike. It's not over.
Yeah, I look, I agree with you, and I really, again, I think it's a little harsh, but I do think there's something to this acronym, this taco trade, because I do believe that people now just don't believe the threats from the administration are going to be carried out. And what makes me nervous, as you said, an hour ago, Trump does not like to be shown up. Trump does not like to be mocked, right? He's the mocker, not the mockee. So he may just do something to say, "Oh yeah, let's see."
Yeah, Mike, and I don't particularly like the acronym. I just don't think this guy at the end of the day chickens out. I like to believe, and maybe it's because I'm trying to be logical, that smart people in the room go, "Hey, we need to kind of ease off on this one a little bit because we are creating big cracks in the dam, and this could end ugly." So maybe there are calmer voices in the room that ask at least if they can tone down some of the rhetoric. And so I don't believe it's an issue of necessarily chickening out as much as, you know what, we're going to push, we're going to push, we're going to push. But if we get too close to the edge, all right, let's back off because at the end of the day, we literally don't want to shoot ourselves in the foot, right? We don't want to create a crisis of our own making. And they came very close multiple times, Mike.
Oh my God! And I look, I agree. I think whether you find it amusing or not, I think it is a little harsh, and I think I think it's somewhere between what he'll call negotiating and the media will call it chickening out. I just think it's part of the process. We knew it was going to be part of the process, and I don't think anyone ever expected, April 7th, what they call Liberation Day, for them to be as harsh as they were, and I think that's what started the decline and him backing off, which is he had to do, is what started the rebound, plain and simple.
Yeah, and look, knowing his personality, I actually give him credit that they backed off a little bit. But we're not through it. And the roller coaster continues. So anytime you get yourself back to break evens, ahead for the year, great time to re-examine where you are, where you are in your risk profile, where you are in your life, and maybe, hey, pick up the. I would tell clients all the time, pick up the phone, tell us what you're thinking.
Yeah.
Tell us if we need to adjust this profile that we have set on your accounts. Let's be proactive about it, not reactive.
Yep. And let's not get complacent.
Definitely not. We're
So
not.
on
We're
that,
not.
no, no, not at all. On that note, Dom, we're going to be back next week. We have a great guest next week, Mara Pendant, who's one of the directors at JP Morgan. Um, she joined our show early on when we first started doing this, and I will venture to guess she's become financial famous since then on TV always. And I'm
Brilliant,
thrilled she,
brilliant.
yeah, brilliant young woman, and thrilled that she decided to come back and join us next week to give us J.P. Morgan and her perspective.
Looking forward to that.
So we'll be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.
Good night, all.